don't chase funding, chase the business. But the purpose of taking that money is not to impress the investor, it is not to impress media, it is not to talk about at parties. That's terrible. Our reaction was all of us.
Hi, this is Vijay Rathod, founder of Soonicornventures, और आपका welcome है in this podcast series. And this is targeted for you as an angel investor who is trying to become an upcoming angel investor or a founder who wants to start up their journey. Today's first guest on the series is Professor Dhruv Nath. So he wears multi hats, angel investor, author of 2 books on startup funding, and then he has been a professor at MDI Gurgaon and vice president at NIIT Limited, also advisors to multiple bigger corporates. Welcome, Professor.
Thank you so much, Vijay.
Professor, I would love to know your journey as an angel investor, right? Because everyone in the ecosystem knows there is a coined term angel investor. What was the first instance where you got into startup angel investing?
So I had actually spent about 20 years in the IT industry. And most of my responsibilities there were as a consultant. So I would, go to organizations like Glaxo and Hindustan Lever and do strategic consulting for them. After which, then I moved to MDI as a professor. And, in any B school, students are very, very keen to catch up with, to meet, and to get advice from people who have experience in industry rather than those guys who simply pick up from a book and talk. So I used to have, a lot of alumni coming to me, a lot of current students coming to me and saying, "Sir, please help kar do. I have this startup. Can you advise me?" And we used to sit down over chai in our open air canteen at MDI, and we had a great time. I realized one very interesting thing, and that probably is what has started my journey as an angel investor. See, I've been in the stock market for 35, 40 years. In the stock market, as an investor, you are very, 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 very passive, right? You invest in a company and that's it. Ultimately, it's up to the founder or the CEO to see where the company goes.
Correct.
For example, suppose I were to invest in Reliance, right? There is no way in hell I can sit across the table with Mukesh Ambani and say, "Mukesh bhai, ये गलत कर रहा है, ऐसे नहीं ऐसे कर." नहीं यार, I will not get the chance. Whereas when I am with these young founders and startups, I am not just an investor. I am also to some extent helping in running the company. And to me, that gave me a huge kick. I mean, it was far, far bigger than, passively investing in HDFC Bank or ICICI Bank or any of these companies. So, which is why I started investing in these. So, I would say my interest in being an angel investor is not only to make money. Sure, I want to make money, obviously. But a lot of it is because I want to be involved in running the show. And if I invest in, let's say, 15 companies, I'm involved in running the show, I'm involved in strategizing. I learn a hell of a lot from these young people. And if I keep learning, I stay young. So I think it's been a mix of involvement, learning, and of course, hopefully at some stage making money, which is why I got in. And today it's a lot of fun. Hopefully, I'll make money as well.
I resonate with that point because when you invest into listed companies, you can buy stocks of ICICI Bank,
Yeah.
Bank, any company, but you don't sit across the
Absolutely.
founders, understand their thesis. When I started investing or maybe getting into investment banking, the same philosophy I follow. The founders sit across the table,
Yeah.
explain the whole business idea to you, and that's gold mine. And then when these companies grow to a scale,
Yeah.
there you make money also.
Not everybody will make money for you, but
Obviously.
hopefully some of them will. Yeah.
Okay, so as you said, not everybody will make money. Let's move to a tougher section.
Mhm.
People think that funding is for everyone, and you just pick up a startup and you get funding. Thanks to Shark Tank also to glorify this whole ecosystem. When we look into numbers, there has been close to 70,000 startups.
Correct.
From 1214 till date
Mhm.
who have launched.
Yeah.
And there is a number which says across 6,000 startups have got funding. So it's less than 10% startup who are getting funding. Forget about how many gets successful and make money. That's even a, let's say, 10%, 20% bracket to open companies only for the funding. This is now the tough question, because only for the funding, or they should build up a profitable business and sustainable business. Don't look at the funding, that will come to you. What's your guidance on that?
Valid question. And I think every founder needs to think about this, and every investor needs to think about this as well. Funding has become an end in itself. बॉस मैंने सीरीज ए रेज कर लिया, अच्छा वैल्यूएशन क्या थी, $100 million, $50 million, वो डॉलर में बात करते, इवन इफ the money is to be used in the rural areas of Bihar, वो डॉलर में बात करते. So unfortunately funding has become the end instead of the means.
Right.
And you have loss making companies, you have companies which may not be going anywhere but they raise money. I think I remember, Sanjeev Bikhchandani, the very, very highly respected founder of InfoEdge, Naukri.com, and so on. He once made a statement which I keep using everywhere. He says, "Dekho, don't chase funding, chase the business. Funding is a means to an end, and that end is a successful business, which means a business which is ultimately growing and profitable. It may not be profitable today. Okay, that's fine. Young businesses cannot be profitable because they have to invest. They have to invest in maybe product development, they have to invest in brand building, etc., building a team and so on. But at some stage, they have to become profitable. That has to be the focus. Now, if you need funding for that, sure, take it. Right? But if you don't need funding for that, don't take it. I think that's very, very, very important. And I've seen a lot of founders, very highly successful founders, who have never taken funding, and they are, I don't want to use the term unicorns because, again, the focus comes back to funding, but they are very, very successful. Zerodha, as an example, Soho, another example. Right? So I would say, don't focus on funding. Focus on building a successful business. And frankly, as an investor, if I see a founder who is only interested in somehow getting funding and is not focusing on his business, there is no way he's going to get no money, right? And I think that is true for all investors who spend some time in the game, right? So funding purely as a means to an end, if you need it. If you don't need it, don't take it. Don't take it simply because you can brag at parties about it over black label.
Correct.
Or single malts.
So, but where do you see this? Currently, all the media companies look towards and overhype, maybe in some cases, that success stories because they raise funding.
Correct.
And I guess there has been a culture which has been built around that. We took names of Zerodha.
Yeah.
Right? These companies didn't raise funding but got popular among the startup ecosystem just because of not raising and building a good set of companies.
Right.
But what I've seen is that there has been maybe a FOMO between founders that to get PR or to get attention of even customers, they are luring towards investors. And this is the culture which I get afraid upon, because now they're not thinking about, I have met founders who will talk to 1 hour how to get funding for their startup. Like they are pitching to investor, and I would see them dumb for 10 minutes when they are going to pitch to customers. And I love to get them to pitch me what you're pitching to your customer, because you're a B2B company. You have a 10-minute and nothing, no presentation, nothing else.
Absolutely. The media has gone ballistic, talking about unicorns and Soonicorns, although that's not the right term to use over here.
That's completely right.
And Decacon and God knows Gigacon and whatever. Again, I'll go back to Sanjeev's comment, Sanjeev Bikhchandani. He says the customer's money is far more important than the investor's money.
Absolutely.
Because if you're getting the customer's money and the customer is coming back, right, then you are likely to run a successful business and you will get the investor's money if you need it. Right? But if you get the investor's money and not the customer's money, that's the end of your business. So even the investor will not come back to you. Right? So the customer's money, far more important. I think very, very clearly it has to be the customer's money. Focus on the business. Yes, I agree with you. There will be a lot of businesses where you do need to spend money and therefore you need investments. Absolutely. For example, if you're running, let's say, a B2C company, right? A B2C company will normally require a fair amount of marketing to build the brand, to attract customers. Right? You need money. Where do you get that money from? I mean, some people may have, their own savings. Some people will pick up a little bit from friends and family, but ultimately you need money from somewhere. So they will need money, accepted. Similarly, if you're building a complex product, once again, you need a team which will build that. Again, you need money. So there are enough situations where you do need money. Take it. But the purpose of taking that money is not to impress the investor. It is not to impress media. It is not to talk about at parties. That's terrible. The purpose is, boss, I need this money. इससे मैं प्रोडक्ट बिल्ड करूंगा, इससे मैं मार्केटिंग करूंगा, लेकिन ओवर टाइम धंधा जो है, आई थिंक धंधा इज द की, ये प्रायोरिटी है. पैसा लेना इन्वेस्टर से ये प्रायोरिटी नहीं है.
That's the crux.
Yeah.
See, I have met some founders when you will ask, they will say we want to raise funding. We have some funny interactions we had with some colleges and universities and all. There has been common trend. People would say,
काय के लिए, किसके लिए?
इसके लिए they will say कि पैसा मिलेगा, we'll build up a business.
So
now you
exactly meaningless.
That's I guess that's not how you should look upon a
Correct.
business. Now this brings to me the what do you say, the $1 billion question, जो अभी last
बस रुपए में बात करते हैं.
हाँ
8,000 करोड़
8,000 करोड़ का question. The question is कि क्या startup को profitability देखनी चाहिए?
Yeah. When the internet came in, it came into the US, let's say in the mid 90s, and it came into India in some small way in the late 90s. Right? So about almost 26 years ago. Everybody is excited because suddenly, there you can do things which you could never do earlier. You can reach your customers irrespective of where the hell they are in the world.
Right.
पहले आपका कस्टमर आपके बिल्कुल साथ होता था, उसी लोकेलिटी में और एट द मोस्ट उसी शहर में. नाउ your customer can be in South America, you can be based in Delhi and your customer could be in Kerala, whatever. The problem is nobody really knew how to make money. They knew that this was something big, it could change the way the world worked, but they really didn't know how to make money. So what they did was they said, okay, let us track visitors to the website. Eyeballs उस जमाने में. It is a little like going to a mall and saying, boss, let's get visitors into a mall. वो खरीदे ना खरीदे, I am tracking footsteps, feet in the mall. Boss धंधा आ रहा है. So obviously that didn't work, and that is why you had the dot-com crash in 2000, where suddenly eyeballs became a dirty word. But you still wanted growth. Right? अब किस चीज से measure करें? Now they said let's chase revenues. Okay? So once again, this mad rush for growth continued. पैसा डालते जाओ, but it became revenues at any cost, even if you're making a loss. You're making a bigger loss next year. So let's say, you've grown your revenues 50% year on year. ठीक है? Your losses have grown 100% year on year. No problem, boss. Growth है ना? पैसा लो. That's what the investor did. And this continued. Now, over time, investors realize, boss, ये long term चल नहीं सकता है. How the hell can this continue here? I remember, Rakesh Jhunjhunwala, unfortunately passed away. He said, how can your profit be the next round of funding? The profit has to come from within the company. So these are not real companies. They are loss-making companies, making bigger and bigger losses every year and getting bigger and bigger rounds at higher and higher valuation. It's absolutely unreal. So now investors say, boss, show me genuine businesses and then I'm willing to invest. पैसे की कोई कमी नहीं. There is no funding winter. I am sure you'll agree with me. But show me a genuine business. Now, what is a genuine business? It is accepted that in the early stages, you will make a loss. Obviously, you have to build up your product, you have to build up your brand and do marketing and so on.
Customer acquisition.
Customer acquisition. even large companies, later stage companies, many of them unicorns, they are currently loss making. They have to move towards profitability. So, in fact, the term that investors started using was, I don't need to see a profit today, but show me a path to profitability. And that's the key. Right? Now, the question is, what is path to profitability? It basically means, was if my cash burn today is, let's say, whatever, 50 crores, 100 crores, next year it has to be less, one more year later, even less, and at some stage, foreseeable future, it has to come down to zero and I become sustainable. That is path to profitability. For early stage startups, my advice, my recommendation to founders as well as to investors is, and that's something so I'm from lead angels, and I mean, all of us basically are in the same environment. What we look at is gross margins, right? And I assume your viewers will understand the term gross margin. So basically, let's say if I am selling a cup of coffee and I sell it for 50 rupees, and the cost of making this coffee, packaging, etc., is, let's say, 30 rupees. That means for every cup of coffee, I'm making 20 rupees. That is my gross margin. In the initial stages, early stage companies, they will not be profitable overall because they have a lot of overheads. For example, spending on marketing, spending on salary, spending on rent, infrastructure, electricity, etc., etc., etc. But the gross margin has to be positive, because if the gross margin is positive, then at some stage you will correct. When you sell a large enough number of mugs, the margin, the 20 rupees times the number of mugs you sold, will be higher than your overheads such as salaries and marketing and so on. So at an early stage, I would strongly suggest that founders as well as investors look at gross margins. Don't look for profits. It's very unlikely you will not get them because people have to invest. But the gross margin should be okay. If the gross margin is negative, then you have a problem, because the more mugs you sell, the bigger your losses. That is not a sustainable.
This is exactly how startups should look at, because whenever we get into companies, right, and if they are not profitable, completely fine.
Yeah.
Because there is also a saying: if they are profitable, why would they need investors' money?
Yeah, that is true.
And that's
You're right. Although you may be profitable, but you may not be growing, and therefore you need money for growth. That is possible.
correct.
It's also possible.
But the unit economics. So I guess
Yeah,
the term,
exactly.
So you need investors should look into the unit economics. If a
Correct.
startup bana rahe,
Correct.
even if you're a
Correct.
founder, you're creating a startup, your unit economics should be strong,
Bilkul.
and the investor should be able
Which
to
is gross
see
margin.
transparently
Gross margin.
the gross correction. Absolutely. Now, heading towards the side of the term unicorn, which we hear every now and then, although now it has stopped. So I have some data to back it. In 2020, there were 12 unicorns minted. 2021, 45.
Yeah.
And that was a year every week you used to listen that this company is a unicorn. It started in January, ended till December.
Correct.
2022, it dropped to 22.
Yeah.
2023 was only 2 startups which got unicorn status. Backing towards the funding has also slowed down, as we call it, funding winter. Last year was not that great because 2020, which was a COVID hit year, it was $12 billion of funding floated, and last year it was $10 billion. 2021 was great because that was the time we used to call ki gadhe घोड़े सब बराबर है. Everyone is getting funding. It's a rush.
Correct.
People are getting left, right in sector. And then this unicorn stature came into picture.
Correct.
But not every unicorn is profitable.
Correct.
Right? So how do you see these big machines? Because we have seen downfall of certain companies. Byju's is one example. We should not take names, but anyway, it's in public market. Right? So if as a founder today someone is opening up a company, should becoming a unicorn should be a target, or becoming a company which is, let's say, sustainable after 3 years or 4 years of age? What should be the ideal standpoint? Although the answer is very obvious, then why should they chase the unicorn status?
Yeah. So, Vijay, I think the answer is in the word unicorn. It's a mythical creature. It's not a real creature, right? Which is very, very apt because these are not real companies. Unicorn is something with a valuation of $1 billion and above. You may be making a loss, you're still a unicorn. Now, obviously, that is not a real company, it cannot survive. The day funding stops, it stops surviving.
Yes.
So clearly, and I cannot repeat this often enough, and this is meant both for investors as well as founders. Do not chase valuation, do not chase. Unicorn cannot be your aim. Your aim is to build a successful company. A company which is a market leader, which has a solid moat, entry barrier, which is scalable, and therefore, and where the customers are happy, they're coming back for more, they are recommending you to other customers. That's a successful company. Valuation is irrelevant. I think what has happened in the last 4 or 5 years since COVID and this so-called funding winter is a very, very, very good thing. Very good thing because now both founders and investors are looking at real companies. Don't focus on becoming a unicorn at all. It doesn't make sense.
It happens
It,
at a stage.
it happens, but that's by the way. That's not your purpose in life, right? Many of these unicorns have got listed in the last couple of years, right? So you had Zomato, loss making, Paytm, PB FinTech, loss making, Paytm, loss making. See, these are listed companies now. Listed companies will not get money unless you're profitable.
And this was very unlikely that a loss-making company is getting listed
They got
and
listed
subscribed also.
because of excitement. Arey boss, you're
Zomato का share
internet
है.
story, unicorn, yeah. So they realized they would not get funding because a listed company will not get funding without profitability. They have all become profitable. Today, Zomato is profitable, Policy Bazaar is profitable, Paytm is profitable, and my guess is all these other guys are now moving towards that. Delivery has just become profitable, right? I think last
Because the unit economics was
Yeah,
meant to be that way.
and they are not chasing valuation anymore, right?
Yes.
So I think it's a very, very good thing. Companies are realizing they have to be real, and a unicorn is not a real company. It cannot be.
Very, very nicely put,
Yeah.
I would say. Right. So let's move towards the best bet you made. I call bet as a wrong word, maybe. Maybe an investment. Your best investment when you like someone, invested, generated profits, not profits, got an exit, not. But what was the best company you invested?
So I think the best one by far is it's a very interesting company called Planet Spark. It's a Gurgaon-based company.
The EdTech company.
EdTech company, correct. Although EdTech is a bad word right now, but these guys are actually raising money at higher valuations. A child in school will go to a tuition center and typically there'll be 6 or 7 kids sitting around the dining table. वो pressure cooker की सीटी बजेगी, then the maid will start shouting and phone बजेगा. Very, very distracting. You have no idea how good or bad the tuition centers are. They said we will organize this business. So they took rooms from Oyo rooms, and they had very good quality rooms, and they created a lot of digital content in the area of English and science. And in that room, they would have laptops, so kids would come, play around with a lot of digital content, and there was a mentor to help them. Wonderful, worked very, very well. And this was the year early 2020, and that is when we invested in them. I personally also invested. March 2020, COVID hit the world, right? Now, kids are not even going to school during COVID, so where the hell will they go to tuition center? No way. But these guys, I think the reason why I like these guys is they don't give up. Kunal Malik and Manish Dhupar, these are the two co-founders. So these guys, they said, okay, we have a lot of digital content. Kids will not be coming to our tuition center anymore. Therefore, we will make all that available online, and even the mentor will be available online. So basically, they switched from a
Offline to online.
physical but digital content offline model to a pure online model. Now the problem is they're competing with the giants in the field, Byju's, Vedantu, all these huge guys. Obviously, they couldn't survive, but they didn't give up. So they said, okay, let us now move towards extracurricular learning. And they tried things like robotics, they tried things like drawing, painting, they tried music, they tried dance, they tried, I think, yoga, they tried lots of things, nothing worked. Right? But they didn't give up. And I think, the one thing which I really respect about these guys is they don't give up. Finally, I think the seventh or eighth pivot that these guys made, until then they were only losing money. They realized a very major problem in the education system. The child goes to school, and the parent obviously wants the child to do well in school. Normally, that means getting good marks. Okay, but that's not enough. The child has to be confident. The child has to be able to face the world. The child has to be able to face the public, and maybe that is a skill which the school does not teach you. They teach you academics in Hindi, English, whatever, science, and so on. So these guys said, okay, let us now launch public speaking for children. Suddenly, nobody was in this. Byju's was not in this. Everybody was focusing on curriculum or on skill building, for professionals. Suddenly, there was a phenomenal opportunity, and these guys cashed in on it. Right? Today, their revenues are approximately about 100 crores a year, right? And growing. And they've gone to adults also, so public speaking for adults. And the one other interesting thing is, since it is not curriculum linked, the market is not just India, the market is anywhere. And the affordability, the willingness to pay in Europe, in the UK, in the US, in the Gulf states is much higher.
During the times they have pivoted
Yeah.
from the model,
Yeah.
they have become they have drawn turnovers of 100 crores in profit.
Yeah.
So I guess that's a great example. I guess you will definitely make money and a good exit.
Hopeful.
Let's move towards the worst bet.
In any field, it's a learning curve, right? And for us also, it's been a learning curve, right? I'll share with you one company that we invested in. I personally invested in. It was called Grey Meter. A student is doing his BTech or BE from some tier 3, tier 4 college. He gets a degree there, but he doesn't have skills. We will build up programming skills, or we'll build up communication skills, or we'll build up selling skills so that he's placeable. And at the end, when he's passed out, we will go to organizations and we'll help them get placed. And they had got a few such students onboarded, and they had some 2, 3 such organizations. The revenue was fairly low. So we said, wonderful, it looks like a great opportunity, because employment in India is a major, major problem, and it's a wonderful opportunity. And these were very, very smart guys. Right? 4 of them were from IIT Delhi, which is where I am from. Maybe that had something to do with it, very juniors. Although I think they were some 35 years junior to me, but very, very juniors. So I invested, and many of us from Lead Angels invested in this company. Tanked. Okay. And we were able to understand over time why it tanked. And the reason why it tanked was, we realized, and this was in hindsight, people or youngsters who go to tier 3, tier 4 colleges, in most cases, there is a reason why they go there. And the reason is they're not serious. They go there not to study. They go there to have a great time with girls and boys. They go there to watch movies. They go there to play cricket, or they go there to, whatever, sing and dance and play the guitar and so on. लेक्चर नहीं अटेंड करते, तुम्हारा स्किल बिल्डिंग प्रोग्राम क्यों अटेंड करेंगे? Finally, this company collapsed because there was no revenue.
That's a great story, and also a great tip for the investors.
Yeah.
Because this story helps investors to understand that the investing into very early stage has gone fast.
Yes.
You don't invest in them now. Let the founders build up a solid business first.
Correct.
At least the first few customers you should have,
Exactly.
and then only you explore.
So you will invest at a higher valuation at that stage.
Maybe that's
That's
fine.
okay,
That's fine.
because the risk is much, much, much lower.
A 10 crore, 20 crore, 50 crore valuation company is fine if it's
Yeah.
sustainable. He has
Exactly.
investors already
Exactly.
investing.
Exactly.
So as we were speaking on it, and let's move towards, because you have been director at Lead Angels, and we are trying to get insights from the thesis of any of the investment platform which are there. So what are the thesis of lead angels when you invest? Because that's also a community of investors. You guys invest.
Correct.
What's the core thesis? If you can just briefly explain us.
Yeah. All of us, I mean, you are also from the same fraternity. I think most of us have a common thesis. Number one, we do not invest in pre-revenue companies as a rule. But if we find them promising, we spend time with them. We are willing to spend time. I personally spend time with them, and at some stage, when they reach revenues which seem enough for us, we go ahead and invest. That's number one. Number two, we usually look at only companies which have some tech component. So, something which is pure non-tech, we would not.
Very
invest
difficult
in.
to scale also.
Very difficult to scale, right? The company should have technology at its core. If the guy says, yes, we have a website, but my company is running a kirana shop, we won't invest, right?
So tech has to be an enablement for it.
Exactly. We look for scalability, I mentioned. Very, very important, we look for an entry barrier. Traction is very important. In fact, we look not only at revenue, but gross margins. Are you solving a problem? If you're not solving a problem, there are lots of tech people who come to, I built this wonderful app. Now I'm trying to figure out, कौन ये use करेगा? Come on, yeah, that's not a sustainable business. You have to solve a problem for somebody, and he has to be willing to pay you for it. Otherwise, you don't have a business. So I think these are the key things that we.
Very nice. I guess we coincide on these.
I mean, we are all in the same environment.
Because when we started Soonicornventures, we got pitches from founders who are very early stage, idea stage, and we being investors, we understand that risk gets eliminated when you enter later.
Actually, not eliminated, it gets
reduced.
Eliminate तो कभी नहीं.
कभी नहीं.
I mean, भाई उसको देखो यार.
So it helps. So as an investor also, I guess this is a great tip for the investors from Professor, that you invest at least little stage.
Yeah.
So valuation बढ़ जाने तो कोई फर्क नहीं पड़ता.
Correct.
Don't get into the FOMO game.
Correct.
What we have seen founders losing money, investors losing money because they followed the FOMO path. And what are the measures that reach out?
Let me just add one more thing. Accept the fact, and this is a message to all investors, particularly new investors, accept the fact that you will be learning. So initially you will make mistakes. You will invest in companies where the company has died and you lost all your money. That's okay. That's a learning curve. But try and stick to these few guidelines. Not very early stage, revenues, gross margin or unit economics being positive, not a crowded market, some traction, scalability, entry barrier. Keep looking for these. Over time, you as an investor will hone your skills. So, the first few companies you invest in, there's a reasonable chance you will lose money. Many investors then give up and say, boss, this is not for me. I think that's the time when you learn. And that's the time you will actually start making money. So you have to be in it for the long run.
So the small checks you pay 2 lakh, 3 lakh, consider that some learning money.
Exactly.
Great. So, Professor, I guess you have done a lot of work with the startups, right? And I guess that's the genesis of these books.
Yeah.
So, to be honest, when I was looking out for companies, and I guess we spoke 3 years back in the COVID times.
Yeah.
Through LinkedIn, we got connected, and I was looking for some meaningful books to read. And there I got to know about funding a startup. That time you were actually getting this out and then attending events for this. So, want to know about the journey of writing this book. So, how did you land up to getting this book? Idea behind it, thesis behind it, and the outcome is anyway fantastic.
Yeah. So, just to explain, this was the first of the books, right? And there's another one. So, funding your startup, and I always like humor, and other nightmares. At MDI, when I started mentoring a lot of these students and alumni, and then I became an angel investor, I realized that founders who are successful generally do the same things right. Okay. For example, they have entry barriers in their business. For example, they are scalable businesses. For example, they are solving a genuine problem, right? They are not entering crowded market. founders who fail, and I have lots of examples of founders who fail, they do the same things wrong, or one or two of those same things wrong.
So there is a pattern.
There's a pattern, right? And as I spent more and more time, and I must have mentored a few hundred such founders, I realized this pattern was something which was useful to founders because they could use the patterns that. So it was not my pattern. It's something I had observed in successful and unsuccessful founders. So what I did was I said, look, I mean, I used to mentor students at the open air MBA canteen, right? Over chai and samosa, which I used to fund. I said, यार तेरे को मैं 2 लाख तो नहीं दूंगा लेकिन समोसा चाय पिला दूंगा. So I said, can I put all this learning that I had into the form of a book so that it is available to founders across the board and also to investors.
Gets documented.
Exactly. The investor always has the option of investing in the stock market, and without taking too much risk by investing in blue chips like HDFC Bank and Reliance and L&T and Maruti and so on, you will still make your steady 14, 15 odd percent on a long-term basis. Some years can be bad, some years can be good on a long-term basis. So therefore, when an investor invests in a startup, there are two fundamental risks associated compared to investing in the stock market. Number one, it is completely illiquid. In the stock market, you want to sell your shares today, sell it, no problem. But in a startup, you can only sell your shares when there is some other investor willing to buy your shares. You don't know when that will happen. Maybe 3 years, maybe 5 years, maybe never.
Undefined lock-in.
Absolutely, completely locked in. And B, it is highly risky because these are tiny companies compared to HDFC Bank. So the 14-15% which you anyway would have got risk-free and completely liquid, if you are investing as an angel investor, you obviously expect far higher returns, which can only happen if the startup grows rapidly and grows to a large size, because that's the only way you'll get a next investor buying your shares. And that is scalability, the ability to grow big and grow fast. At an early stage, you really do not know what direction the business will take. Right? I'll give you the example of Zomato. When Zomato started, it was called, it was only listing and it was called Foodie Bay. Okay, it was not even Zomato at that time. And the co-founder, not Dipender Goyal, but co-founder came on record. I think Twitter he must have mentioned this. We will never get into food delivery. And today, look at them. They are food delivery and they are only into food delivery. So you just don't know, since it is so early, what kind of pivots you'll go through, what will happen to the business. So at a very early stage, the investor normally looks more at the founder than at the business. I had put this down, and in this book, as well as the next one, which is the Dream Founder, I use the persistent model. I think what is very important here is this talks about success stories as well as failures, because I believe you can learn as much, if not more, from failures than you can from successes. So the gray meter example I shared with you is there in this book, right? Planet Spark is in the second book. So you got successes as well as failures.
Wonderful. So I guess that's a quick note on these books. If you are a founder or investor, you should definitely go and check out these books. I guess these are available on Amazon.
Yes.
And they can definitely go and buy the copies. I got my signed copies from
wow.
from Professor. Yeah. Any investor who is now jumping the wagon and they want to invest into startups, quick tips for them. What is the specific percentage they should expose themselves to the startup world?
So I will take you to a wonderful comment I heard from Deep Kalra. Right? Deep Kalra, by the way, is on the book. Sanjeev Bikhchandani is also in the books. In fact, they've written the forewords for these two. So Deep Kalra, the founder of Make My Tip, he says this has to be play money. Okay. There is no fixed percentage. It actually depends on your overall corpus. So obviously, if you have a crore, and so let's say you have a crore and you have enough running sources of income, whether you're running a business or whether you're salaried or maybe you're a couple with both people getting a salary, I would say put in maybe 5 or 10 lakhs. right? If you have far more, which means you have a lot of surplus money, your percentage can grow higher, right? So I think it depends on your the size of the corpus, and whether you are, um, whether you're getting in money every month or not. But basically, it is money which your
Your
day to
safety
day
net
life,
has to be
correct, cannot be dependent on this. This is something which you can put aside. If the entire thing tanks, it should make a difference to your lifestyle. That is what Deep Kalna calls play money, and that's my recommendation.
Because see, if you are thinking that investing into startups is going to create wealth, that's definitely going to create wealth, but not from your safety net.
Yeah,
So we call it a safety net. You don't
Or
invest
startup.
from your money which is saved for your daughter's marriage or
Correct.
something
Oh,
else.
bilkul nahi. No way.
Don't do it, because that will be a big mess.
No way.
And diversification, which is likely
Yes.
important. If someone comes to our fund, they have to invest 25 lakh rupees in 5 years' time. This is saving guidelines.
Correct.
So our typical guideline is that you invest 2 lakh rupees each, let's say spread across 10 to 12 startups in next 2 years,
Yes.
so that you're diversified.
Absolutely.
And sectors, pick up sectors which you understand, and which the startup, which you hear about, that okay, this company is going to go big in this sector, pick them up. So I guess that's a great tip. Thanks a lot for that. And let's discuss about the red flags which you see in founders, and you will try to check so that investor will also understand that this kind of trend can be avoided.
Okay, I'll share with you one story. It's a very interesting story in a very, very common situation, and a modified version of that story is there in this book. So, in the year, it's a slightly old story. In the year 2014, in the month of November, there were three very bright engineers. They came to us. So at Lead Angels, we at that time most of our pitch sessions used to be physical. So in Delhi, we had these three bright engineers, and they said, "Sir, we have a waterless urinal. We have a design for a waterless urinal." Okay. Now suddenly there must have been some 25 investors sitting around the table. Suddenly we all got excited. And the reason why we got excited was the date. Because 3 months ago, 15th August 2014, Prime Minister Modi had announced Swachh Bharat Abhiyan. Right? Now, Swachh Bharat Abhiyan was a brilliant concept. Let's focus on building toilets. Right? Nobody in an Independence Day speech, no Prime Minister had ever said this. But he said this, and he said the government will support it. Whatever. Right? Build X number of maybe 2 crore toilets or whatever. The problem is, you may build these toilets, where is the water? So, in many places, in villages, small towns, even in big towns, there's no water. So, therefore, who's going to maintain them? How will they be cleaned? That was a fundamental problem. Now, suddenly, we had these three bright engineers. They said, "Sir, we have a solution." And we got really excited. So, we said, "Okay, just remember one thing," and I'll take you back to the persistent model. This product does not have an entry barrier, because somebody sitting in Okhla, a shed in Okhla can manufacture something similar. You will have lots of people manufacturing something like this. Therefore, the only way to create an entry barrier is you have to grow very fast. Appoint distributors immediately, and make sure you spread fast, so that at least there is some level of your costs get amortized, your brand gets built, and so on, and therefore you're hopefully ahead of the other guys. Sir, we'll appoint distributors. Yes, sir, immediately. So we said, just give us 1 month, but we like the idea, and most likely we will invest, but let's evaluate this in a little more detail. So we came back, and all of us, there were only men there in that room, all of us spoke to our wives and said, this is the time.
Gold mine.
असली मतलब जो ज्वेलरी खरीदनी जो करना है खरीदो, because we are investing in this. So we went back after a month. We called them, and we had decided हम तो invest कर रहे हैं. And these three guys were looking very, very excited. We said, क्या हो गया? Oh sir, we have now started working on a female version of the same thing.
Not executing the instructions
So is it female version? What about the male version? जो आपने दिखाया था, हाँ सर वो है, सर वो है. तो यार वो डिस्ट्रीब्यूटर जो अपॉइंट करने थी क्या हुआ? Sir, just give us 5 months. In those 5 months, the female version will be ready. Then we will appoint distributors. You know what our reaction was, and you must capture this. Our reaction was all of us. Why? Because these guys, they were engineers, they had no clue about business. You may have a wonderful product. A lot of bright young tech guys fall in love with their product, but they have no idea where the market is, how do we market it, the fact that we have go to market quickly. So they had converted this into an R&D project. We said, sorry, we are not investing, but if you were to get a co-founder, not an employee, if you were to get a co-founder who understands business, who understands sales and distribution, then we are willing. But as of now, we are not. So, this is one simple example of where I talk in the persistent model, I talk about team. A team which has only tech people, and you have a lot of such founders, they may have a wonderful product, but it doesn't work because they don't understand business, and that's the problem.
That's a big red flag. If
Absolutely.
someone is
Absolutely.
only a techie
Correct.
but doesn't understand the business acumen,
Exactly.
they should be businessman.
Has to be one guy who understands business.
Very nice example. Very
And
nice.
I've heard tech guys who say, I don't like to sell. Oh, bhaiya, if you don't like to sell, don't start a business. Boss,
Don't
that's your
sell it to
primary
us also.
purpose. Your primary purpose.
don't sell investment to us also.
Correct.
Very nice, very nice. So for the viewers, we have a platform called as Soonicornventures. We have svdeal.com. On this, when you land up, you will find deals on the platform. So every month we bring 4 companies on this platform who come and pitch. It's a fortnight pitch calls. And Professor, I guess I will just drive you through this. We'll pick up one company and we'll try to understand how you will evaluate as an angel investor. Right? So on the platform, you'll find all the sectors, like we have D2C, close to 15 companies over there, and 6 drones. Go to a hot deal. Okay, this particularly is a good company to discuss, Dharaksha. Right? And they recently came on the platform and we are writing a check to them. It will be close to 50-60 lakhs combined from angels.
Maybe we'll also join it.
Oh, wonderful. So that's a co-investment project. So let me just take you through Dharaksha, what these companies are doing.
Yeah.
So our founders, Arpit and Anand, has formed this company. And the idea behind this company was that when I heard the pitch for the first time, that these guys were sourcing the paralis from the farmers and then processing it and making packaging materials for the D2C brands. Now, why I liked it, I can just give you my thesis. Because they are hitting 2 birds with one stone. That you are creating an impact by not getting the air getting polluted, because that's a grave problem in Haryana borders, right? And then all the thermocol and plastic being used are packaging materials of these fancy D2C brands who are selling, going all in to create a good experience for their customers. They're using mammoth of thermocols. So now they are having this business model that they're reducing the air pollution and also preparing packaging materials for the D2C brands. Again, doing some decent revenue, like 60 lakh rupees of revenues, 2 crores of letter of intent, which is per month, and they have done 20,000 packages. What do you think about this kind of a company? Although they have raised good amount of capital, they have raised out of this 5 crore round, 3.5 crore committed, we are giving 50-60 lakh crore rupees is, I guess, already available. So, as per you, if this company is coming to you, like, what's your feedback on this kind of setup?
It's solving a very, 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 very genuine problem. In fact, like you rightly mentioned, it's solving 2 problems. One is the eco-friendly packaging problem, and 2 is the pollution problem in the not just Delhi, but I guess the whole of North India. Any solution like this, at some stage, even the government will start supporting it, because even the government is concerned, right? And whether it's a state government or the central government, will probably get some level of government support, or possibly, the government will say, look, we may not be able to fund this, but we will allow CSR funding. So we put this under the category of CSR, and therefore there'll be enough companies willing to put money here.
There are 2 stakeholders in this.
Yeah.
One is farmers, second is the D2C brand. brands.
Yeah.
Where do you see why they will adopt this
Yeah.
solution?
So if you look at the B2C brands who are creating packaging material, there it is very, very clear they are getting a solution which avoids plastic, which avoids anything which is non-biodegradable. And in any case, government guidelines are moving more and more towards more and more eco-friendly products, this whole ESG business. One thing which I think the founder needs to look at is how easy is it for him to get the farmer to switch to this? Because for the farmer, you just burn the field, you bring a whatever lighted stick,
Just a matchstick.
eight matchstick or whatever, and the entire field is gone. And we've seen that happening all the time. So that is issue number one. Therefore, if these people, and I think they are, if these people are sending their own teams where the farmer has to do nothing, they actually cut the entire stubble, then you're not asking the farmer to put in extra effort. One thing that everybody has to keep in mind, whether founder or investor, is your customer, try and minimize the effort from his side. Don't get him to change the way he behaves.
Remove all the frictions.
Exactly, all the friction. So if the farmer, he lights a match, on the other hand, he just makes a phone call and says, "ठीक है, आप आगे ले जाओ." It's equally simple.
And I think he can pay small minimum amount also to get rid of this.
Small amounts, because increasingly the government, and I would suspect a lot of that small and minimum amount will probably over time get funded by the government.
Subsidized with the government.
A farmer who says, "Boss, what is my option?" The farmer next door will tell them, "अरे यार आप इनके पास जाओ, Dharaksha." What is it?
Dharaksha.
Dharaksha. उनके पास जाओ, because by then the brand has been built. So I think the key here is don't get the farmer to change the way he works. That's not easy. And B is you must scale up rapidly, which is probably why they're raising funding.
So that brings to the closure of today's podcast. हमने बहुत length में discuss किया. Be it how you start as an investor, how you pick up good companies, how the startups fail into their whole journey, and what are the quick tips. I guess the persistent model was very, very insightful. I hope we are able to give justice on this podcast. Professor, any closing remarks for maybe the listeners?
Yeah. So, message to founders, first of all, the same message which I've been giving all along. Don't chase valuations, don't chase money, chase your business. If you chase your business and you need money, the money will come, right? Don't chase money. And for investors, remember, the most important thing is the founder, but try and keep in mind this persistent model. So invest in companies which are scalable, invest in companies which have an entry barrier, which are genuinely solving a problem, and which have some level of traction. And please remember, it's a learning curve. Do not give up. If you start and you find your first one or two investments have collapsed, that's normal. Don't give up, because use that learning to make better decisions in the future.
Perfect. So I guess on that note, we can conclude this series. Any questions you may have, drop into comments. We will be happy to answer. Thanks a lot for watching. See you in the next video.